This is the luxury world. Get inspired with us today and tomorrow. In this video brought to you by the luxury world, we will begin with a thought-provoking scenario, one that may initially sound counterintuitive. What if a substantial 20% increase in the retail price of imported Swiss watches in the United States made them more accessible? At first glance, this idea seems improbable. A dramatic price hike on highly coveted steel sports watches, imposed hypothetically through U.S. tariffs, would appear to place these timepieces further out of reach for most collectors. Yet, under the surface, the situation may not be as straightforward as it seems. This scenario could disrupt long-standing market dynamics in unexpected ways, possibly tipping the scales in favor of everyday enthusiasts. To understand how this might unfold, it is necessary to examine the core concept that has been driving much of the frenzy in the watch world over the past several years: price arbitrage. The ability to profit from price differentials between the retail and secondary markets has played a central role in shaping availability, demand, and pricing behavior. By grasping the mechanics of this arbitrage, one can begin to assess how a sudden 20% retail price increase due to tariffs could alter the market equilibrium. Price arbitrage, at its core, refers to the practice of purchasing a good at a lower price in one market and selling it at a higher price in another. This concept exists in numerous industries, from limited edition sneakers to concert tickets. In the context of Swiss luxury watches, particularly brands like Rolex, arbitrage has flourished due to the substantial gap between official retail prices and the prevailing prices on the secondary market. To illustrate this with a specific case, consider the Rolex GMT Master 2 Pepsi. Historically, this model retailed for approximately $10,800 through authorized dealers. However, high demand and limited supply have driven its value on the secondary market to around $19,000. That creates an immediate potential profit of roughly $8,200, which represents a 78% return, an incredibly rare short-term gain in any market. Such returns naturally attract a wide range of participants. Alongside genuine enthusiasts, investors and flippers have poured into the space, motivated more by financial upside than horological appreciation. As a result, demand has exploded for certain models. This creates a feedback loop. High resale value leads to high demand, which leads to scarcity at retail, which further inflates resale value. The loop continues indefinitely, powered largely by arbitrage incentives. This mechanism explains the notorious waiting lists at authorized dealers. When buyers see an opportunity to flip a watch for a quick and substantial profit, they are willing to endure long wait times and jump through various hoops to secure a purchase. As long as the resale market remains robust and prices stay far above retail, the incentive remains intact. Now introduce a new variable into this equation: a hypothetical 20% tariff on imported Swiss watches in the US. Such a move would instantly raise the retail price across all affected models. For popular steel sports models, this could mean a price surge of several $1,000s overnight. The immediate effect is clear. Consumers must now spend significantly more to acquire a watch from an authorized dealer. Purchase history and allocation hurdles remain, but now with an added financial barrier. At first glance, it may seem logical to assume that secondary market prices would rise proportionately. After all, if retail increases by 20%, shouldn't the resale market follow suit to maintain the same arbitrage potential? However, the situation is more nuanced. Market dynamics often resist linear adjustments, and several factors could prevent secondary prices from increasing at the same pace as retail. Consider the demand side first. Not every buyer who was previously comfortable paying the existing market price will be willing or able to stretch another 20%. The psychological impact of higher sticker prices, particularly once certain mental thresholds are crossed, cannot be underestimated. As prices climb, buyers often pause, hesitate, or explore alternative options, such as other brands, models, or asset classes entirely. Simultaneously, the supply side could see a shift. Some current owners may view the elevated retail prices as an ideal moment to sell and capture profits. Dealers, too, might choose to offload inventory in anticipation of market saturation or simply to free up capital, especially with higher acquisition costs. Furthermore, international dynamics come into play. Higher prices in the US compared to regions like Europe or Asia would likely encourage more cross-border sales and gray market exports to the US, further boosting local inventory levels. Taken together, These forces push demand down while potentially increasing supply. The outcome is a new market equilibrium that may land higher than before, but not 20% higher. This means that while secondary market prices may rise, they are unlikely to mirror the full extent of the retail price hike. This shrinking of the arbitrage gap marks a pivotal shift. Revisiting the earlier example of the GMT Master 2 Pepsi helps illustrate this dynamic. Before the tariff, retail stood at $10,800, while the secondary market price hovered around $19,274. After a 20% retail increase, the authorized dealer price rises to $12,960. If secondary prices rose by the same percentage, the market price would hit $23,129. However, due to the market forces discussed, it's more likely that resale prices would rise only partially, perhaps to around $21,200, representing a 10% increase. Under this scenario, the potential profit drops to $8,240. While this remains a healthy margin, the percentage return is lower, and the initial capital outlay is higher. For speculators, this changes the fundamental appeal of the trade. The investment case becomes less compelling. With greater capital tied up and diminished returns, the risk-reward profile begins to erode. In addition, the broader 2025 market environment has already seen certain Rolex models, particularly those in precious metals, selling below retail on the secondary market. These watches often carry high purchase prices but lower demand, and a 20% tariff would only exacerbate the imbalance. Buyers would be asked to pay significantly more at retail for a product that immediately depreciates upon resale. From an investment standpoint, this is highly unattractive. This reality places increasing pressure on the speculative side of the market. Reduced profitability on highly sought-after models, coupled with negative value propositions on others, begins to undermine the overall buy Rolex as an investment narrative. In response, some financially motivated buyers may choose to exit the market altogether or redirect capital elsewhere. For everyday watch enthusiasts, those interested in ownership rather than flipping, this market recalibration could bring unexpected advantages. As speculative demand subsides, authorized dealers may experience reduced pressure on allocation lists. Less competition could, in theory, translate into shorter wait times and improved access to models that were previously unattainable. Moreover, the narrowing gap between retail and secondary prices changes the perception of value on the pre-owned market. While secondary prices remain elevated, the difference compared to retail has diminished. For certain models, especially those still commanding a premium, the secondary market may begin to appear more reasonable, particularly as supply grows and buyer urgency diminishes. One likely outcome is a noticeable reduction in waiting times at authorized dealers. As flippers and investors find fewer compelling reasons to chase allocations, and as the financial upside erodes, fewer names may crowd dealer lists. Enthusiast-driven buyers may find themselves better positioned to acquire desired models. The secondary market itself could become more active. As owners seek to capitalize on high price, and as dealers look to optimize cash flow, more watches may be put up for sale. This increased volume enhances variety and selection, making the buying experience less frantic and potentially more consumer-friendly. Furthermore, regional disparities may widen. If U.S. prices spike due to tariffs while European or Asian markets remain stable, the arbitrage window opens in reverse. Watches from abroad could flood into the U.S. through the gray market, capitalizing on the price imbalance. This could create new inefficiencies and short-term market distortions, fueling yet another cycle of cross-border trading. Predictions for the U.S. market include shorter waiting lists, narrower resale premiums, more active secondary markets, and broader regional price gaps. Though elevated prices may remain a reality, the shift in market behavior could offer benefits to serious collectors and reduce the frenzied competition of recent years. This scenario demonstrates how policy changes, even seemingly adverse ones, can lead to unexpected consequences in the world of luxury watches. In a market long dominated by speculation, the return of more organic demand may prove to be a silver lining. What are your impressions on the Rolex topic we shared in this video? Let us know by leaving a comment and giving this video a thumbs up. Do not forget to subscribe to the Luxury World for more insights into the world of luxury timepieces.